Market hits day's low as stocks trade weak ahead of Powell's speech later today. All sectors apart from realty trade with losses. FMCG as well as autos are the worst hit today.
Tata Steel slips as pressures in Europe hurt profitability, while weak sales and a sharp dip in margin of Novelis hurts Hindalco.
Tata Steel, after Tata Steel, well, Adani stocks see a reversal of their selling streak, and strong results of Adani Transmission are a surprise, even as several other group entities are set to report earnings today.
Muthoot Finance slips on posting weak AUM growth, while a sharp contraction in margins hurts Balaji Mines, but Paytm jumps following a sharp conference call upbeat and a potential ban on other lending apps.
Hello and welcome to Business Lunch. I'm Nisha Podar, and with me as always is my co-anchor Pavitra Parekh. Well, Pavitra, good afternoon. Another weekday of market, and yes, there are lots of global cues that the market really has to digest from, and especially the central bank move. So yes, Fed chair will be in focus tonight, and tomorrow will be our own RBI policy. Now, take a look at the market. At the low point of the day, Nifty 50 has lost about 83 points in trading session right now, closer to 0.5% loss. And remember, this is after opening over 100 points from these particular levels. So keep an eye out on that. When it comes to Bank Nifty, which is right now outperforming the key indices, the mid-cap index, which was a clear outperformer yesterday, is still an outperformer, but still slipped into the red about a 0.25%. Lower in trade at the moment. Advanced decline ratio has to be in favor of the declines, but the real jolt on the advanced decline ratio is not as much, considering the fall of Nifty 50 and the overall market sentiment, especially with mid-caps outperforming the key indices. Some green on the screen for Adani stocks is probably a welcome sign for the market today, Pavitra.
Oh, absolutely. And by the way, Adani Ports numbers are flashing on your screen right now. So EBITDA has come in at around 2,700 crores. This is versus the poll that we had of 2,950 crores. So there has been a miss on that one. If you take a look at the margin, that has come in at 56.3%. This is the margin for Adani Ports. The poll that we were working with was around 62.1%. So the two figures that I do have, there seems to be a miss right now on these. The stock is also coming off the highs. It was, like Nisha mentioned, holding up well in the green, but it has slipped from those levels. In fact, Vivek is standing by now to bring us a complete wrap of what's really going on with the Adani group of stocks. Vivek.
Well, that's right. They've been the newsmakers, and the news flow continues. So what actually happened is, post yesterday market close, number one, you had the results of Adani Transmission, a very strong operational set of numbers. You also have Adani Ports, that just declared its results, operationally slightly weaker than our poll, but still it continues to remain in the black. Now, yesterday, another important development happened, especially when you're talking about Adani Group stocks. The promoters actually said that they look forward to reducing pledge shareholding as far as 3 group companies are concerned, and the reduction of the pledge was quite significant. So in Adani Ports, 12% of total 17.5% that they have pledged will be reduced. Adani Green Energy, 3 out of the 4.66% that they had pledged will be reduced, and Adani Transmission, 1.4% of the total 6.62% will be reduced as far as the promoter pledge shareholding is concerned. We are also awaiting the results of Adani Green Energy. You're also awaiting the results of NDTV as well as Ambuja Cements. Now, from the recent intraday lows, especially when you're talking about the F&O stocks that have been very volatile, the recovery has been very sharp. So Adani Enterprises has actually moved up 80% from the recent intraday low that we saw a couple of sessions back. Adani Ports up over 40%, Ambuja Cement up over 20%, and ACC up over 18%. And in the cash segment today, after quite a few sessions of continuously hitting lower circuits, the recovery has been quite sharp. So Adani Transmission, after the results yesterday, plus 10%, Adani Green Energy over 8.5%, Adani Total Gas continues to languish at the lower circuit for 8 straight sessions, and NDTV2 has recovered 12%. Now, all eyes tomorrow will be on the call, the analyst as well as the institutional call that Ambuja Cements is holding. And remember, Karan Advani, the CEO, will be there. So it's going to be interesting to see what are the commentary coming in from that as well.
All right, Vivek, thanks so much for getting us the full roundup of all the action in Adani Group of companies there, and flashing on your screens Adani Ports numbers, but the stock price really not impacted by it. In fact, still holding above the 4% and gaining despite a miss on several points in terms of the numbers and the performance. So we'll wait for more analysis on those numbers, but staying with the group companies details, well, my colleague Abhishek Kothari has compiled a list of lenders having the exposure to the group companies. Abhishek, give us those details and which bank has more exposure to this group.
Well, the data has been compiled with the managements of the lenders, speaking of from brokerage house notes like Macquarie, etc. So lenders of banks and NBFCs have an exposure of about 57,000 crore to Adani Group, which forms about 0.7% of 0.9% of their loans. So 6 lenders have an exposure of about 59,751 crores, which forms about 0.96% of the total book. The amount-wise highest exposure is of SBI, which is about 27,000 crore, forms about 0.88% of their overall loan book. Percentage-wise, the highest exposure is of REC, that is Rural Electrification Company, who did mention to us today morning that they have an exposure of about 7,000 crore. This forms about 1.7% of the total loan. Macquarie has written a note wherein, IndusInd Bank has an exposure of 1.5% of their overall growth, overall loan book, and Axis Bank has an exposure of about 1.2% of their overall book. So these are the exposures of lenders to Adani Group, which have been known to us, publicly available figures. Back to you.
All right, Abhishek, thanks a lot for detailing all of those numbers out for us. In fact, this morning we also spoke to Marco Papik, who's partner and chief strategist at Clock Tower Group, to really understand what he makes of this entire Adani Group saga that's been playing out in the Indian markets. Listen in.
In the West and in the US in particular, this has been covered really in great detail, focusing on the report by the Hindenburg research firm and the Adani Group. So there has been a plethora of focus on the specifics, which I think is interesting because you would think that people in the West would take a more broader macro perspective on India itself and not obsessed about an individual group, no matter how, of course, important it is to the economy.
All right, so those were all the details. But one important group in focus today, another conglomerate, is Vedanta Group, and that's in focus. The stock is trading lower today after sources told CNBC-TV18 that the government was opposed to Hindustan Zinc's buyout of Vedanta's global zinc assets, as it believes that the decision was not in favor of minority shareholders' rights and violated the corporate governance norms. And sources also told CNBC-TV18 Sapna Das, who earlier broke that story, that exchanges filings were done despite that government-appointed director's objection to this particular transaction earlier today. In response to the story, Hindustan Zinc filed a clarification with the exchanges that the incorporation of international zinc assets was approved by the board and was an attractive opportunity for overseas growth. And the company also said that it is not aware of any information that had not been disclosed to the exchanges. So that's the Vedanta Group development there. Remember, the government has a golden shareholding in Hindustan Zinc. With that, we'll slip into a short breather on Business Lunch, but come back next up. We get you the details of CNBC-TV18's RBI monetary policy poll ahead of the decision tomorrow. So what is corporate India and the economists really expecting from tomorrow? Get to know that after a very short break.
Hey guys, welcome back. You're still tuned into Business Lunch on CNBC-TV18, and like we've been telling you, the two-day RBI monetary policy meeting is underway and they are going to declare their decision tomorrow. So ahead of that, we have the CNBC-TV18 poll and Ritu standing by with all of the results. Ritu.
Well, with inflation softening and the US Federal Reserve also moderating the pace of its hikes, 70% of our respondents said they expect RBI to settle for a smaller rate hike of 25 basis points this time around, with 30% voting for a status quo policy. But more importantly, it looks like we're nearing the end of this rate hike cycle, with 100% of the respondents saying that the February rate hike will be the last one, which brings us to the peak rate in this cycle, and there 90% expect 6.5% to be the peak repo rate. On the inflation front, majority is expecting that RBI will lower its inflation forecast for the fiscal by about 10 to 20 basis points, given the cooling off that we've seen in the last few months. On the macro GDP front, no change is expected, 6.8% growth forecast for FY23. Now, on the stance, the street is divided, however. 40% believe that it will retain the stance at withdrawal of accommodation. 20% believe it will tweak the wording of the stance without shifting it. But 40% do expect RBI to shift its stance to neutral this time around. In terms of other things that the markets will be watching out for, one, any soft signal about a pause come April from the governor's statement this time around. And secondly, the continuing dissent within the MPC on the policy action is also something that the markets will keep an eye out for.
All right, Ritu, stay on. There's one more development in what appears to be a fresh crackdown on the digital lending apps in India. Well, the Ministry of Electronics and Information Technology has started blocking betting and loan apps with alleged links to China. Ritu, tell us more about this and who stands to benefit from it.
Well, we understand that several prominent digital lenders are facing a potential ban on their applications and websites in India following a directive from the Ministry of Electronics and Information Technology, which we understand has drawn up a list of such lenders that are to be removed from the Google Play Store and given this list to Google, and separately also given a similar directive to internet service providers as far as the websites of these companies are concerned. Now, it is unclear what the reason behind such a move is, because remember, recently the ministry had drawn up a list of about 230 odd apps, which included 138 betting apps and 94 loan apps with alleged links to China and involvement in money laundering, which the ministry had banned. Now, whether or not the likes of LazyPay and Kisht, which have been affected, are part of this list is not is unclear at this point of time. But the fintech associations and founders and CEOs of these companies, we understand, are meeting with the officials of the Ministry of Electronics and IT to seek clarification on the matter and the rationale for such a move, and to seek a removal of this ban on them, because they claim they have no links with China and do not understand why they've been made part of this list. This does affect their loan repayments and also addition of new customers through their apps and websites. LazyPay confirmed the development to us, saying that its app and website were affected but did not specify the reason for that, whereas Kish did say that they're aware that Google had been asked to take down a list of companies which was drawn up by the ministry, which includes their company. They were uncertain as to the reason for this, but they will be meeting with officials to seek a clarification, and had reasserted that they have no Chinese stakeholders whatsoever.
All right, so that's the clarification as well as the understanding of the entire development there. But take a look at Paytm shares. They have been overexcited in trade today, spiked up in trade, and then have been still gaining about over 8% in trade. Let's shift focus to the REITs and InvIT side and take a look at Embassy REIT, a listed REIT in India, and how the share price or the unit price of that REIT had fallen right after the budget announcements. If we really take a longer horizon of that intraday, of that chart, we will see that it had fallen and it remains at those very levels as well, even though gaining in trade today. So let's talk about what really budget has done to this space. The budget proposal includes a big dampener for the listed REITs as well as InvITs, wherein the distribution of cash under debt repayment will come under the tax net for the first time. Now, to understand this and the impact on Embassy REIT, I caught up with the CEO of Embassy REIT, and he tells me that 40% of the cash distributed by the company is in the form of debt repayment, which could come under tax as per budget proposal. And on the other hand, the yields impact in the hands of the unit holders could be to the tune of 50 to 100 basis points. Take a listen.
So the recent budget announcement relating to taxation of one of the three components of distribution impacts annual returns by around 0.5 to 1%, out of the mid to high teen returns which the REIT product has been envisioned to deliver. So yeah, while the recent budget announcement was a surprise to the industry, REITs continue to be a total return product which offers stable and predictable cash flows with long-term growth upside. Their debt repayment year to date has been about 40% of the overall distributions. And this is the component which is now proposed to be taxed as other income at the marginal tax rate. This is applicable to all investors, not necessarily a particular retail or sponsor investor. And in effect, what it means, Nisha, is that the new tax proposal impacts our post-tax distribution yield to the extent of roughly 50 to 100 basis points, depending on investor category, which in turn implies that about 8% to 16% of our distribution element of our product, of the total return that we speak of, it's impacted.
All right, that is the word coming in from Embassy REIT. We are going to get into a short break now, but on the other side, we get you details of the earthquake in Turkey and Syria. So all of the details and a ground check lined up on the other side.
Welcome back. You're watching Business Lunch, and take a look at Adani Port stock. That is the one getting impacted because of the results and has lost most amount of gains. So keep an eye out on that. Was holding up with good gains for the rest of the trading session so far.